What is Reg D 506C? Here's my beginner's guide for investors and syndicators that explains everything you need to know. If you're looking to raise capital for a private equity fund, real estate syndication, or any private investment offering, you may have heard of Regulation D. But what exactly is Rule 506C? And also, how does it compare to 506B? Well, today I'm going to break it all down for you in simple terms so you can understand how this exemption works, how it has revolutionized the investment world, and whether it's right for your fund or investment opportunity. And stick around to the end because I'll also cover key requirements and the major differences between 506B and 506C. By the way, welcome to Fund Playbook. This is a show that's all about how to launch and raise capital for your very own private fund or real estate syndication. I'm your host, Jimmy Atkinson. Let's dive in. Now, to really understand Regulation D, Rule 506C, you first need to understand what the private investment world was like before Rule 506C existed. Reg D has been around for a very long time, but 506C is a much newer addition. Let me explain. Regulation D was created under the Truth in Securities Act of 1933. This law was created to regulate the securities industry in response to the stock market crash of 1929 and the ensuing Great Depression. This 1933 law also created a new regulatory agency, the Securities and Exchange Commission, better known as the SEC. But what even is a security? Well, in this context, it's basically any investment, such as shares of stock or membership interests that a private fund or real estate syndication will offer to raise capital from investors. It represents ownership or a promise to pay money in the future. When you syndicate a deal to raise capital from investors, you're offering a security. The primary goal of this new securities law in 1933 was to protect investors by requiring that they have access to sufficient information before buying securities or making investments. But it also allowed for certain exemptions, such as for private offerings offered under Regulation D. Now, Reg D is really just a set of rules that allows funds and syndicators to raise unlimited amounts of money from investors through private offerings without having to register the investment with the SEC like you would for a public offering or IPO. But for 80 years under Regulation D, access to investments was restricted to the ultra wealthy and very large institutions. Main Street investors simply were not able to access these types of private offerings, and the offerings couldn't even be advertised to the general public. That all changed in 2012 when President Barack Obama signed the Jobs Act into law. This new law revolutionized the world of private investments with the creation of Rule 506C. But what is it exactly? Well, Rule 506C essentially rewrote Regulation D to loosen several key restrictions for private offerings. The biggest change that came with 506C? For the first time, it allowed fund managers and real estate syndicators to publicly advertise their investment offerings, something that was previously prohibited. The general solicitation provision of Reg D 506C means that you can now use advertising, social media, email campaigns, even YouTube videos like this one to attract investors to your private fund or real estate syndication. It truly democratized access to private investments that typically had only been available to connected, super wealthy investors in decades past. But there's a catch. Under Rule 506C, you can only accept accredited investors, and you also must take reasonable steps to verify their accreditation status. I'll come back to what that means later, but even with that catch, Reg D 506C is still, in my view at least, the best way for most syndicators and fund managers to raise capital from investors. The other type of Reg D offering is the 506B. More on that a bit later. But first, you might be asking, do I really even need to know all this stuff? Well, let's break it down for two groups, fund managers and investors. First, for fund managers or real estate syndicators, 506C is a superpower. It lets them raise unlimited capital without the costly and time-consuming process of an IPO. Plus, they can now openly market their deals, or what the SEC refers to as general solicitation. Before 506C, you couldn't advertise your deal publicly. You had to rely on pre-existing relationships to raise capital. But now it's perfectly legal to advertise a private offering under Rule 506C as long as the investors in the offering are verified as accredited investors. And this is a game changer for scaling up fast, particularly if you don't have a huge network of financial advisors and investors that are already familiar with you. For investors, especially accredited investors, Reg D 506C opens doors to new investment opportunities. Think private equity, startups, real estate, stuff that you just won't find on the stock market. These alternative investments can offer higher returns, though they do come with higher risks too. It's like getting VIP access to the investing world, and you don't necessarily need a middleman like a financial advisor or broker dealer to access 506C investments, but you do need the financial chops to qualify, which I'll explain in a moment. But bottom line, 506C bridges the gap between ambitious projects and wealthy backers. So now I'll go to the whiteboard and I'm going to list the 4 key requirements for Reg D 506C offerings. And these requirements come straight from the SEC and are legal obligations for every fund manager or syndicator who wants to raise capital directly from investors under Reg D 506C. So the 4 key requirements are: 1, only accredited investors. Revisiting this term I introduced earlier, every investor in a 506C fund or deal must be accredited. So what is an accredited investor? Well, simply put, it's any individual earning over $200,000 a year or $300,000 jointly with a spouse. You can also qualify as an accredited investor if you have $1 million of net worth, not including your primary residence. Requirement number 2, verification. Fund managers and syndicators can't just take your word for it that you're an accredited investor. They have to verify accredited investor status with documents like tax returns, bank statements, or a letter from your accountant. Requirement number 3, Form D filing. Fund managers and syndicators are required to file Form D with the SEC within 15 days of receiving the first investment. Filing notices and fees may also apply at the state level too. And finally, requirement number 4, no bad actors. The key people involved with the investment offering can't have certain legal troubles. Perhaps most importantly, no past securities fraud convictions. Oh, and while advertising is allowed, it has to be truthful. No shady promises of guaranteed returns or getting rich quick. All securities transactions, even exempt transactions, are subject to anti-fraud provisions of federal securities law. Run afoul of these laws, and you can be subject to not only civil, but also criminal penalties, which means that in cases involving serious investment fraud, you can be sent to prison. Earlier, I mentioned another similar type of investment offering, a Reg D 506B offering. There's a lot of similarities between Reg D 506B and Reg D 506C. They both have to file Form D, and they're both subject to the anti-fraud provisions of federal securities law. But there are also 4 very important differences between 506B and 506C. So now let's compare 506B and 506C side by side. The biggest difference, of course, is that with 506C, you can freely advertise your investment to the general public, but you must verify accredited investor status, and you can only accept accredited investors into your fund or deal. It's really a trade-off. Do you want broader marketing capabilities as a 506C, or do you not want the hassle of verifying the accredited investor status of all of your investors, and possibly also want the flexibility to accept a few non-accredited investors as a 506B? If you're raising a small amount of money and you think you can complete the fundraise with your pre-existing relationships, then likely a 506B is the way you want to go. But if you're raising a larger amount of money, or if you don't have a network of investors and financial advisors to rely on, if you don't think you'd be able to raise all the capital from pre-existing relationships, and if you know you want to be able to market your deal or fund at conferences or on the internet, maybe on social media or YouTube or on your own website, perhaps a different crowdfunding platforms, or if you want to perform email marketing, then a 506C is really the only option you have. Yes, you will have to verify the accredited investor status of every single one of your investors, but this process really isn't all that daunting. In fact, it's just one extra step in the subscription process for your investors, and you can scale so much faster. That's all for today. Thanks for watching this video about Regulation D, Rule 506C, and how it changed the game for investors and fund managers who are raising capital for alternative investments. If you liked this video, hit that like button. And if you have a minute, leave us a comment. You can also subscribe to Fund Playbook on YouTube or your favorite podcast listening app so you always get our latest episodes. I release new episodes each week about how to start and raise capital for your own private fund or real estate syndication. Thanks for watching and listening. See you next time.